Welcome to Casa Academy Chapter 13, Part 2, where we will cover types of mortgages and sources of financing. Because most homes are bought with financing, the availability of mortgage money plays an absolutely critical role in both the real estate industry and the broader economy. Real estate activity is a massive driver for Florida's economy, so keeping a steady, affordable supply of mortgage funds flowing isn't just good for business, it's literally vital for buyers, sellers, lenders, and honestly, the marketplace as a whole.
Here's our roadmap for today. We'll be covering 1. Financing real estate. 2. The primary market. 3. The role of brokers. 4. The secondary market. 5. Key market players. And finally, 6. The big picture.
Section 1. Financing real estate, past versus present.
To really appreciate how the mortgage industry works today, we kind of need to look back at how restrictive lending used to be. Years ago, buying a home meant you needed some serious savings. Imagine needing a massive 20% down payment before you could even hope to qualify for a mortgage. Buyers would typically take all those savings down to a local institution, usually called a building and loan association. These community groups would take deposits from local members and then use those exact funds to make home loans. It was a very closed loop. Today, thankfully, things operate much differently. We have vastly more diverse financing options, and a lot of modern loan programs allow qualified borrowers to buy homes with relatively small down payments, or in some specific cases, no down payment at all. But that brings up a really great question for anyone getting into the real estate profession. If we aren't just walking down to the local building and loan association with a giant 20% down payment anymore, where do borrowers actually go to obtain mortgage financing today? Section 2, the primary market, the front door. You can think of the primary market as the front door of real estate financing. This is the market made up of the institutions that originate loans directly to borrowers. Whether they're using their own funds or arranging financing through outside sources, their main job is to create or originate those mortgage loans. Now, there's a really interesting concept here called warehouse lending. A mortgage lender is licensed to lend money, sure, but where do they actually get it? While some use their own capital, others will literally borrow funds from commercial banks and then turn right around and lend those funds to your buyers. That specific practice, a lender borrowing money just to fund your home loan, is known as warehouse lending. Definitely keep that vocabulary term in your back pocket. So who actually makes up this primary market? Well, it's a mix of a few specific types of lenders. First off, we have savings and loan associations and commercial banks, which use everyday depositor funds to make those mortgage loans. Then we've got credit unions. These are unique because they're actually nonprofit financial cooperatives owned entirely by their members. We also see life insurance companies playing a big role here. They pool together premium income and often provide the heavy financing needed for larger commercial and multifamily real estate projects. Next up are real estate investment trusts, or REITs, which are formed specifically to invest in mortgages and real estate assets. And finally, we have mortgage bankers, who originate loans on behalf of investors or funding sources, processing the applications and often servicing those loans long after the closing day. Section 3. The role of brokers, intermediaries in the lending ecosystem. Now, brokers are incredibly important players in the lending process, but they occupy a very distinct, specific place in the market. I need to make this crystal clear because it is a classic exam trick question. Mortgage brokers do not actually lend money. Let me say that again. They are not lenders. They absolutely do not use their own funds. Instead, they act strictly as intermediaries between the borrowers and the lenders. So, if they aren't handing out the cash, what is their actual job? Brokers are basically the matchmakers. They help borrowers gather all their necessary documentation, they identify the absolute best loan programs for that specific buyer, and then they submit the applications to the lenders for approval. The loan itself is funded and closed in the name of the actual lending institution. For example, a broker might bundle up a massive stack of documentation, label it as file number 989877, and submit that entire package to a wholesale lending department for review. They facilitate the connection, but they are never the source of the funds. Which leads us to a bit of a metaphorical question. We know primary lenders are out there lending money. But what happens if a primary lender's well runs dry? Well, before we answer that, your verification code is 123400. Now, back to our lender's well. One of the biggest challenges primary lenders face is keeping enough available funds on hand to continue making new loans. Think about it. If a lender originates a 30-year mortgage and just holds on to it, their money is tied up for decades. If they keep every single loan they originate, eventually they are simply going to run out of money to lend. Section 4. The secondary market, replenishing funds.
The ultimate solution to a primary lender running out of cash is the secondary market. This is the financial mechanism that steps in to make sure the primary market doesn't just freeze up due to a lack of funds. It solves the primary lender's problem by purchasing existing mortgage loans right off their hands. Think of it exactly like fresh water refilling a well. This action replenishes the primary lender's bank account, allowing them to turn right around and continue making new loans to new borrowers. And usually, this is funded by investors who provide capital to the secondary market by purchasing mortgage-backed securities. Because mortgage loans are generally considered pretty low-risk investments, these securities attract a massive range of investors, and that's what keeps the whole system liquid.
Section 5. Key market players, secondary market organizations. So who is actually stepping up to buy all these loans? There are three major participants in the secondary mortgage market that you absolutely must know. They're often called the Big Three. We have Fannie Mae, Freddie Mac, and Ginnie Mae. Let's break down exactly what makes each of them tick.
First up is Fannie Mae, officially the Federal National Mortgage Association. They purchase FHA, VA, and conventional mortgages. Fannie is the oldest and one of the largest participants out there, operating as a shareholder-owned corporation, though with certain government oversight. Then we have Freddie Mac, the Federal Home Loan Mortgage Corporation. They also purchase FHA, VA, and conventional loans specifically to help maintain liquidity in the market. And like Fannie, they are shareholder-owned. Finally, we have Ginnie Mae, the Government National Mortgage Association. Now, unlike the first two, Ginnie Mae is a completely government-owned corporation operating directly under HUD. They support FHA, VA, conventional, and USDA loan programs, and they play a massive role in affordable housing and urban development initiatives. Now, outside of those big government-sponsored entities, the secondary market also has portfolio lenders and private investors. These are the groups that focus on non-conforming loans. They serve borrowers who might not fit into neat traditional lending boxes, like self-employed buyers with tricky income documentation, real estate investors, house flippers, or builders looking for construction financing. Because these loans inherently carry a higher risk, these private investors are going to charge higher interest rates in exchange for those higher potential returns.
Section 6. The big picture, life cycle of a loan.
Okay, let's tie this entire life cycle of a loan concept together so you have a crystal clear understanding of the process from start to finish. It's so important to see the relationship between these two markets. On one side, we have the primary market. They serve as the originators. They deal directly with your borrowers to actually create the loans. On the other side, we have the secondary market, acting as the purchasers. They come in and buy those existing loans. This symbiotic relationship creates a continuous flow of funds, constantly replenishing the primary lenders, so that mortgage financing remains available for all of your future borrowers. Understanding this cycle isn't just about passing a test. It's about understanding the actual lifeblood of your future business. So I'll leave you with this provocative thought. As a future real estate professional, how will you use your knowledge of this continuous flow of funds to confidently guide your buyers to the closing table? Because when you know exactly where the money comes from and how the well is constantly refilled, you are infinitely better equipped to help your clients secure the homes of their dreams.